Hi, this is Professor Karen Lin. Welcome back. In this video, we are going to discuss transaction analysis. Let's get started. Accounting transactions are the business events that would affect a company's accounting system. For example, if a company purchased inventory and paid cash, it would change a company's inventory level and also the cash level. This transaction increases inventory and also decreases cash. So transaction analysis is the type of analysis accountants use to analyze how a business event or accounting transaction would affect a company's accounting system. Let's start with something called the accounts. Accounts are a basic element of accounting system. Accounts are used by companies to accumulate the dollar effect of transactions. Now, what does that mean? We can visualize accounts as different buckets. For example, if we have a cash account, you can visualize it as you have a cash bucket. The cash bucket may have some cash in it because investors or creditors give us some cash. Now, when we purchase inventory, as we mentioned before, the cash account will decrease. So the water in this cash bucket will decrease. So an account is basically a bucket trying to show us the net effect of the business transaction. So every company basically has a list of accounts. We call that a chart of accounts. Now pay attention, every company is different. For example, if you run a bookstore versus if you are Google running searching engines, you guys have different type of business and thus have different types of accounts. So you don't need to memorize a set of accounts or like a standard set of accounts. We know every company may have cash, may have accounts receivable, but they have different accounts. You don't have to memorize. And accounts are usually organized by financial statement elements. In the balance sheet, it's assets, liabilities, stockholders' equity. In the income statement, revenues and expenses. So here is a table showing different types of accounts under different categories. For example, under assets, you will see cash, short-term investment, and so on. Under liabilities, you will see payables, stockholders' equity, common stock, additional paid-in capital, retained earnings. Under revenues, all types of revenues. Under expenses, different types of expenses and cost of goods sold. Now, the purpose of this list is not having you memorizing all the accounts, but you know where you can find them when you need them. When we talk about the analysis of transactions, we may come back to revisit this list of accounts. All right, so now let's start talking about transaction analysis. When we do transaction analysis, these are the principles. First of all, every transaction has at least two effects, which we call dual effects on the basic accounting equation asset equals to liability plus stockholders' equity. And this accounting equation will be used when we do the transaction analysis. Keep in mind, you should always keep your accounting equation equal. All right, I repeat, you need to keep asset equals to liability plus stockholders' equity equal all the time. All right, now let's illustrate transaction analysis using Chipotle. This is an example of Chipotle issuing new stocks. Chipotle sell 100 shares of common stock with a par value of 1 cent. What is a par value? Par value is basically a face value of the stock. It's usually typically very small, 1 cent, $1, very small. But when it sells on the market, it sells at the market value, which in this example is 17 cents. Why is market value higher than the face value? Because the investors sees the potential of Chipotle in the future to grow. So the investors will purchase the stock typically higher than the face value of the stock represents. So the face value is just the nominal value, and then the market value is how much the stock is really worth on the market. So Chipotle received $17 in cash from investors. Now this is a financing activity, how the company funds itself. So we are going to try to analyze how this transaction affects Chipotle's financial status. So in the next few minutes, I'm going to introduce how we are going to do it. So when we try to analyze a transaction, there are basically 3 steps. The first step is ask yourself, what was received, right? So in this example, obviously, Chipotle received cash. So cash is received. And what are the accounts affected? Obviously, cash account is affected. And also, what is the account? Is it asset, liability, or stockholders' equity? Cash is an asset because cash is an economic resource, control owned by the company, giving benefits to the company for the future, and it's measurable, right? It fits the definition of assets. So it affects cash and it affects asset account. And what is the direction? We are receiving it, so cash increases. That's the direction of cash. All right, your second step is to ask yourself what was given. Now in this example, Chipotle issued new stocks, so we give out new stocks. And also, you have to repeat the first few steps, right? What are the accounts affected? Obviously, common stock will be affected. Maybe something else. We're going to talk about it. And then what are the classification of that account? It's stockholders' equity because it represents the claim of the shareholders. Finally, what is the direction of common stock? It increases common stock because we issue new stocks. Finally, we need to make sure the accounting equation equal. All right. So in this example, again, what was received? It's cash and it's an asset account. Increase A means increasing assets. How much? $17, right? How do we calculate? We sell it in the market, 17 cents per share, and we sold 100 shares. So that's $17. What was given? Now we give out common stock with 1 cent per share on the face value. Now face value of a stock is classified as common stock, or we record that as common stock. So common stock increases and it belongs to stockholders' equity SE. How much does it increase? It is 1 cent multiplied by $100, right? So that's $1. So common stock increased by $1. What else? We receive $17, but common stock only increased by $1. There is a $16 of something else that has been increased as well. So what has been increased? Now this is something we called additional paid-in capital. All right, my students usually ask me, why do we need both accounts? So this is just for the accountants. Accountants are people who want things to be perfect, basically. So we want to separate transactions or accounts with different nature. Now, why are they in different nature? Because common stock represents the face value of the stock. And the difference between the market and the face value, which means the $16 in total in this example, would be the premium that the shareholders pay because of the potential that the company is going to grow. So that $16 will be recorded in something called APIC, additional paid-in capital. Now this is just an account name for premium, basically. All right, so now we understand cash increases and also common stock and APIC increase. We would be visualizing or put them down in the form of the equation asset equals to liability plus stockholders' equity. You will see cash underneath asset increase by $17. Common stock, APIC, are 2 different accounts underneath stockholders' equity or belonging to stockholders' equity. Common stock increased by 1, APIC increased by 16. So 1 plus 16 is 17. you will see your equation is equal. Verify that your equation remains equal because your left-hand side of the equation increases by 17 and your right-hand side also increases by 17. So your equation maintains equal because you increase your left-hand side and your right-hand side with the same amount. Okay, here I summarize the 4 different ways that you could keep your equation equal. If we view the equation as left-hand side versus right-hand side, the first way to keep it equal is to increase your left-hand side and your right-hand side with the same amount simultaneously, obviously. So the example would be what we just discussed. If we issue new stocks, that increases common stock, which is under stockholders' equity, and it also increases cash under assets. The second way is to decrease both sides in the same time with the same amount. So for example, if we pay back a bank loan, now when we pay back a loan, the loan under liabilities will decrease and cash under assets will also decrease. Make sure they are in the same amount though. The third way is to increase and decrease on the left-hand side. For example, if we collect accounts receivable, which means someone else owes us money and now we collect them. When we collect the accounts receivable, that person no longer owes us, so we decrease accounts receivable by the amount. Because we collect that, we get cash, so cash will be increased. Both cash and accounts receivable are under assets. So we increase cash, but we decrease accounts receivable for the same amount. The net effect of this is 0, right? 100 plus minus 100 equals to 0. So 0 on the left-hand side and 0 on the right-hand side. So your left-hand side and right-hand side will be equal. Finally, you could add and subtract the same amount on your right-hand side simultaneously. For example, this is a more advanced example. In this example, we accrue wage payable, which means we hire someone, did the work, but we haven't paid them yet. All right. When we have not paid them yet, we still need to recognize they have worked for us. That's the expense that we have used or incurred to generate revenue. So it's called wage expense. So when that happens, we hire someone, they have worked for us, we increase wage expense for 100. Now when we increase wage expense, it's not in our balance sheet, right? Revenue expenses are in the income statement. The only way it enters the balance sheet is through that expenses reduces the cumulative wealth that the shareholders have because you spend something. You spend on something. So wage expense basically decreases retained earnings. And wage payable is under liabilities. So wage payable will increase. Now again, if we hire someone, we know we're going to pay them in the future. That increases liability, wage payable. And also decrease the cumulative profits the shareholder owns under the account called retained earnings. So retained earnings decreases, wage payable increases. When you add them up, that's also 0. Now, if you don't understand this part, it's fine. We are going to come back to this. But the idea is that when you do your transaction analysis, make sure what you did falls within one of these 4 situations. It either increased both sides with the same amount, decrease both sides with the same amount, or increase and decrease the same side by the same amount simultaneously, which means the net effect will be 0 on both sides. All right, one more example, purchasing assets. Chipotle purchased for cash $26 in new equipment and then $5 in intangible assets. This is an investing activity. So what was received in this example? Obviously, we received new equipment and we got intangible assets. Now, intangible assets means assets has no physical form. For example, patent is an intangible asset. So we received $26 of equipment, $5 intangible asset. They both are assets. And then what was given was cash. So 26 plus 5, we paid $31 in cash. If we write that in this equation, you will see everything falls under the left-hand side, which is under assets. Cash reduces for $31, we gave up cash, and we obtain equipment and intangible assets. 5 plus 26 equals to 31. So you will see this basically falls in increase and decrease the same side for the same amount. So the net effect becomes 0. All right, in summary, transaction analysis involves identifying accounts affected by a transaction and recognizing at least 2 accounts are affected, sometimes 3 accounts, 4 accounts. And then you need to classify those accounts as asset liabilities or stockholders' equity, and then to determine the direction of the effect. In addition, you need to identify asset equals to liability all the time. And practice makes it perfect. So you need to practice, practice, and practice. To get more details, I would recommend reading the book and also watch the McGraw-Hill guided help video that I put out on the Blackboard 2-1. All right, I'll see you in the next video.